Everyone keeps asking the same question in different words. Is crypto about to replace banking? Or is banking about to absorb crypto until it stops looking like crypto at all? Because right now, the loudest signal isn't price, it's infrastructure. Bitcoin can be up or down this week. ETFs can cool off. Headlines can swing sentiment. But under the surface, the more important story is this. The rails are changing. Here's what's happening in plain language. First, Bitcoin is still behaving like a macro asset that lives and dies by liquidity and risk appetite. Lately, it's been hovering around the high 60s, struggling to reclaim key levels while ETF inflows have slowed compared to the earlier hype cycle. That doesn't mean the story is over. It means the market is doing what markets do, pausing, repricing, and waiting for the next catalyst. But Bitcoin is only one layer. The more immediate collision between crypto and banking is happening through stablecoins. Stablecoins are basically digital dollars that move at internet speed. They're designed to be boring, and that's exactly why they matter. They don't need to moon, they need to settle. And stablecoins have quietly become one of the most important bridges between crypto and traditional finance, because they function like a payments rail more than a speculative asset. That's why regulation is heating up. In the US, Treasury is on track to issue implementing rules for the Genius Act by mid-July 2026. That's not some abstract policy footnote. That's a timeline. And when stablecoin rules become clearer, banks and large institutions can move from experiments to products, and you can already see the tension forming. Banking trade groups are pushing regulators to slow down approvals for crypto bank charters, arguing the rules and risks, especially around stablecoins, aren't fully settled. In other words, banks are worried that new entrants will get access to the same privileges without the same constraints. At the same time, the conversation is shifting from banks versus crypto to banks plus crypto. Even mainstream finance outlets are now describing tokenized deposits and on-chain banking as a plausible path forward, where banks keep customer relationships, but the settlement layer becomes programmable. So what does that imply for fiat currency? Here's the part most people misunderstand. Fiat isn't dying because a coin replaces it. Fiat changes when the rails change. If stable coins and tokenized deposits become normal, your money still looks like dollars to you, but it behaves differently behind the scenes. Faster settlement, 24/7 payments, programmable transfers, new compliance tooling, and potentially new forms of financial surveillance depending on how it's implemented. And we're already seeing governments test the idea of digital currency infrastructure in the real world. For example, India has expanded pilots using its central bank digital currency for targeted public distribution and aid delivery, showing how digital money can be designed for specific use cases, not just general spending. That brings us to the real fork in the road. The future is not simply crypto wins or banks win. The future is which system becomes the default settlement layer. Because whichever layer settles value becomes power. If stablecoins dominate, the dollar's network effect may strengthen globally, because a digital dollar that moves instantly is extremely attractive for cross-border settlement and global commerce. If CBDCs dominate, governments gain finer control over distribution, policy tools, and compliance. If banks dominate with tokenized deposits, the system evolves but keeps the traditional gatekeepers. And the most likely near-term answer is messy, all of the above in different regions, for different use cases at the same time. Now let's talk about the banking part directly. Banks are not blind. They see what's happening. They see customers moving value on weekends. They see settlement expectations changing. They see stablecoins turning into a shadow payments layer. And you can see it in how companies are positioning themselves. Some crypto platforms are diversifying beyond just number go up, trying to become financial super apps with memberships, markets, and broader product lines to survive bear cycles. So what can we realistically say the news is telling us is in store? Here are the 3 most defensible takeaways from the current signals. 1. Crypto markets will remain volatile, but the infrastructure story keeps marching. ETF flows can cool off, price can consolidate, but the rails do not unbuild themselves. 2. Stablecoins are becoming the main battleground between banks, regulators, and crypto because they sit closest to everyday money. The fight isn't about a meme coin. It's about who gets to issue, distribute, and profit from digital dollars. 3. Digital fiat isn't a single event. It's a gradual migration. People wake up one day and realize the system already changed because the user experience stayed familiar while the settlement layer evolved underneath. And that's the part that feels like the quiet shift. Not a dramatic collapse. A subtle replacement of rails. Same money. Different rules. Different speed. Different power centers. So if you're watching crypto versus fiat like it's a boxing match, you might miss the real story. The real story is the rewiring. And once the rewiring is complete, the arguments people are having today will sound outdated because the new normal won't feel like crypto at all. It will just feel like money. This is the quiet shift.